About 2 years ago, Tony Robbins wrote a book called Money, Master the Game. It was about a 600 or 700 page book. I got it on tape and I listened to it right away. And it just, gosh, there were so many things wrong with it. There's so many ideas that were, I could see that he wanted to figure out this whole money thing, but he was getting most of it wrong. And I, I didn't do any podcasts about it. I was just like, okay, no one really. I mean, is anyone gonna? I mean, Tony's an empire builder, and he inspires people and he motivates people, and he self-describes himself as the why guy. So I was like, okay, I mean, this is what often happens with people who have had accomplishments in other areas, grow your money areas of your life, but in the earnings world. And Tony's extremely accomplished around earning money and creating companies and building empires. But the world of growing and protecting money is completely different than the world of building empires and creating and generating revenue. And so when he went into the keep it and grow it world, he just got so many things wrong. And, just in many ways, I was like, okay, whatever. I kept it to myself. And you know what? I think that was a shame because that book sold over 1 million copies. And I heard a bunch of other people talk about how many things he got wrong. And it didn't surprise me when he came out with kind of a follow-up to ... hopefully fix the problems. But as I read this book, listened to it, God, there were so many things wrong with it. And it got me so angry. Like, I'm so mad with how much he's missed so many things. But now, I think people are believing him. And so I'm going to do a series of podcasts, and this is just one of them. But I've got to get this off my chest because it's really pissed me off, and it's pissing me off, and it's going to hurt a lot of people. Hey everybody, this is RC Peck, and this is my weekend podcast. I hope you all are open to a very candid conversation with me. I'm going to talk about a very specific person, and really not just a specific person, but a book that he wrote, and the book is called Unshakeable. And, pretty cool title. You don't want to be shooken or shaken. You don't want to have your deepest beliefs hurt, especially about the future. Last week I talked about expectation. The definition of expectation is your deeply held beliefs about the future. And I talked about how people do not rise to the level of their expectations, but they fall to the level of their training. And unfortunately, I think a lot of people are going to read, or in my case, listen to Unshakeable, and they're going to take that as, oh no, I got training. No, I got training. I read the whole book. But I'm pretty pissed at Tony. He, I'm going to put all the parts together, but there's one thing he pointed out that it just makes my blood boil. It just really pisses me off because it's so wrong. So at the beginning of his book, and I'm going to bring the date up right here. At the beginning of his book, he talks about how if you miss out, and if you ever listened to Tony, you know that his voice is like this. If you miss out. So he talked about if you miss out on the 10 best days of the market, and I'll get to the data on the screen here, but he talked about how, to be out of the market is really silly. And in fact, he shames people in this book. He shames you to think that you should ever be out of the market. And so what he talks about, the data point he uses, he says, look, if you just buy the market, and here's the data on the screen here, and this data is from 1927 to 2015, so pretty long period of time. You put $1 in the market on 1927, and in the end of 2015, that $1 grows to $115, right? So you get this amazing 11,000% return. But then what Tony does is he goes, but if you just miss the 10 best days between 1927, now he doesn't say necessarily 1927, he might have said 1929, he may have said the last 85 years. Okay, but he says, if you miss the 10 best days, okay, the growth of your money shrinks by 2/3. So instead of that dollar growing to $115 or having an 11,000% return, your dollar only grows to $38, or you only have a 3,700% return over that 80 some years, right? And so his point was, if you just miss the 10 best days, you're screwing yourself. And he goes on, and here's what people aren't going to catch. Tony, if you're really unbiased, if you're really balanced, if you really want to make sure people are unshakable, you would take both sides of that. You'd say, look, if you miss the 10 best days, you better talk about missing the 10 worst days. And so the next section here is, if you were to miss the 10 worst days between 1927 to 2015, you grow your money by 36,000%. You grow your money 3 times better than just a buy and hold. You grow your money 11 times better than if you just miss the 10 best days. So it's complete garbage. I call bullshit on it, Tony. You're shaming people. You're scaring them. You're saying to them, no, you got to stay in the market. You got to stay in the market because, hey, if you just miss the 10 best days, you're screwing yourself. But shame on Tony. Because if you really want to be balanced, you say, look, if you miss the 10 best days, it's going to really hurt you. And if you miss the 10 worst days, it's really going to help you. And I'm going to get to that. But guys, if you miss the 10 best days and the 10 worst days, which is more likely than anything else, you're basically going to grow your money about 4% better than if you just did a buy and hold. Now, 4% better is not that much better over 87 years, right? So my point is not to miss the 10 best or the 10 worst. My point is, when someone is giving you information, take the opposite side, challenge it, flip the question, challenge them. Because if you don't challenge their frame and their anchor, you're going to hurt yourself. And Tony he's an expert at framing conversations and anchoring you to numbers. And he anchored people to, you can't miss the 10 best days. You can't miss the 10 best days. And I'm going to go on to this in future podcasts, but he goes on to say, so you got to just stay in the market. You got to stay in the market. Never get out of the market. You got to stay in the market. And you've heard this before, right? These are the 3 things that every big box conventional advisor has told you. Never get out of the market. And all you need to do then is just diversify and rebalance. So I want to point something out to you. Look at the price chart here. This is a price chart of the S&P 500. And the blue line is a 200-day exponential moving average. And I want to point something out about data and volatility and missing or not missing moves. And clearly from the previous data, your brain can go, wow, if I miss the 10 best days, it's going to hurt me. But man, if I miss the 10 worst days, and this is what I noticed when I got into this 20 years ago, wow, missing the 10 worst days, growing your money is more about not losing it than swinging for the fences. That's what I got out of it. But look at this price chart here. This goes back to 2007. I just want to point out a couple things about this price chart. And the thing I just want to point out is, guys, bad things happen to people's accounts when the S&P 500 is below the 200-day moving average. Now, I'm not suggesting you use the 200-day moving average. There's much better moving averages to use, and you never want to use just one moving average. You really want to use a combination of 2, like a pairing. But here's the thing. Since 1960, so not trivial, we're talking 50-some odd years, 57 years. Look at this. 22 of the 25 worst days since 1960 all happened below the 200-day moving average. If we expand that, we can see that 83 of the worst 100 days all happened below the 200-day moving average. My point is, there's patterns. And if you turn on your pattern recognition brain and you change the questions you ask, you start to notice things. You start to notice, avoiding really bad days, really bad periods, man, that can help me. knowing when it's below the 200. And I hear you, RC. There's better moving averages. But if I just notice when the price is hanging out below, that's where people are getting shaken, right? That's where people are getting hurt. It's not about buying and holding and just diversifying and rebalancing, which is actually what Tony is telling people to do in Unshakeable. And it just gets me so mad because he's literally shaming people that, no, don't get out. Don't get out. It's hurting people. Do the work. Ask the hard questions. Notice the frame. What frame is the person talking to you about? When I mean frame, the big context, right? So when you go see a big box or conventional advisor, their big frame is, hey, it's dangerous out there. It's unpredictable, totally random. You never know what's going to happen. Therefore, we're just going to hold your money. We're going to have your money in the market forever. We're never going to get out of it. But don't worry, we're just going to put you in a well-diversified portfolio over 10 asset classes, and we're going to rebalance it once a year. Well, why should I be in? Well, it's random. That's the frame. Is it really random? And that's what you have to challenge. It's like you have to challenge what you might be taking as gospel. And that's why you have to be a financial heretic. You have to be a heretic, right? You do. Now, that's a religious word, but a heretic, literally, it's a Greek origin. I guess most words have Greek origin. Certainly a lot of them do. And the origin is Greek, and it means able to choose. To be able to choose. You want to be able to choose. And when people wanted to choose other things against the church, they were called heretics. But you actually want to be a financial heretic because it helps you protect your money. You really want to make your money unshakable? You really want to have stability and steadiness? Be a financial heretic. Be able to choose. Question, question, question. Okay, so what's the takeaway? There's a couple things. Be skeptical. Challenge, 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 guys. This idea, this frame of never getting out and just diversifying and just rebalancing, guys, I call bullshit on it. There is a better way. It doesn't have to be complicated. Doesn't have to be scary. I'm not talking about spending more time watching the market closer. Absolutely not. You don't need to. I'm not talking about buying more story-based pick of the month newsletters. And you know the conventional approach doesn't work. And anytime you ever have someone talking fees, talk about our fees. I mean, our fees are really great. We have great fees. You know why they're talking about their fees? Because their performance is the market minus 2%. Anyone who leads with fees, first of all, I mean, basically fees are free today anyway. But anyone who touts their fees, they're basically saying, look, our performance is going to be the market minus 2%. So you know right away if someone's talking to you about, our fees are this and we'll lower our fees for you. Man, our fees are really good. Now, guys, I just want you to know, you shouldn't be paying sales fees and 12B fees and high fees on mutual funds, and you should actually never be buying mutual funds. So I'm not saying ignore them, but what you want to know is it's about performance. It's about approach. It's about strategy. That's what matters most, right? It drives me crazy when someone's like, what are your fees? I'm like, that's the wrong question. I'll tell you what they are, but that's the wrong question. The answer is, look, how'd you do when things went sideways? And I mean emotionally sideways. How'd you do when things completely fell apart? What do you do when the market's in a stable uptrend? Ask the hard questions, and then your money will be unshakable. Hey guys, this is just another step in helping you protect your future and your portfolio. Until next time, this is RC Peck.